and welcome to this Union Budget call for FY24 with Aditya Birla Asset Management. We will wait about a minute or so, and then we will start the call. So today for this call, I have with me Mr. Bhupesh, who is a fund manager and also an economist. And also alongside him will be Mr. Mahesh Patil, who is the CIO and looks after the entire investment deck. So just allow us a minute. I think we are 200. Okay. So I'll hand over the call to you, Bhupesh. We'll start the call at this time, and over to you, Bhupesh. I think you're on mute, Bhupesh.
Yeah, sorry for this. Yeah, thanks, Joseph, and welcome everyone for the call. So, so yesterday we had this budget. We all know market has already given this reaction. The broad theme of the budget has been that they wanted to push for capex as much as possible within the fiscal constraints. So they had 12. In any budget we have the simple mathematics, which is that we have receipts on one side, which includes tax. On the other side, we have expenditure. And on the third, the receipts minus expenditure gives you the fiscal deficit. So the government has, to play with one of the three, two of the three or three of the three, to get the desired outcome. And what they did was that they reduced the fiscal somewhat. Taxation all they remained pretty much similar, and they increased the capex. So that's how they played. This is the headline fiscal number here. If you can just have a look. So this is the fiscal deficit. So while fiscal deficit came down from around 6.4% to 5.9, this happened broadly because of the reduction in expenditure, and over there mostly the revenue expenditure. In terms of taxation and receipts, they remain pretty much the same. So just keep this thing in mind that they combined some fiscal consolidation and added some amount of capex to that. This chart gives a better view that from a fiscal deficit of 6.4, they reached a fiscal deficit of 5.9. How did they do it? Reduction in food subsidy. So last 2 years we had very high expenditure on the food subsidy part because government had this free food scheme. This year, because things have turned normal on the COVID front, therefore this fiscal, the food subsidy requirement came down substantially. That was one point from where government saved a lot of money. The second was on the fertilizer subsidy part, because last year we had this Russia-Ukraine war, and because of that we had big spike in commodity prices, particularly urea and also fertilizer prices, gas prices. This time those prices have came down significantly from the last year's level. Therefore, there is going to be some saving in the fertilizer subsidy also. Otherwise, in others, some expenditure also, they need a lot of saving, because typically, governments, if they don't, the saving happen mostly by keeping expenditure flat, not by cutting it, but because normal GDP is always growing, so that resulted in the reduction in the total expenditure. They also had some decline in the transport states. But with all this saving, they also increased substantially the capex part. So the government's drive has been, to do as much capex as possible. And with all this combination, the deficit came down from 6.4% to 5.9%. Just a little longer term view of deficit, you can see we used to run, in the time of crisis, global financial crisis, we ran very high deficit, 6.1% to 6.5. This resulted in a big crisis, the taper tantrum. We had very high CAD and the BOP crisis, the currency blew off. Following that, the government returned to the fiscal consolidation roadmap, and they were steadily bringing down deficit towards 3% when COVID struck, and because of which government had to sharply increase this deficit. And now they have come back to the fiscal consolidation part. And the aim is to bring down this deficit to 4.5% by FY26. Just keep this in mind. The second part, which is the revenue deficit, the fiscal deficit will include capex also. If you just look into the revenue deficit part here, this is the more important part, because that is the current expenditure minus current receipts. Here we can see that the consolidation has been very, very significant. So that's one thing to note, that the quality of government's deficit has been improving, and the quality of government expenditure has also been improving. And how do they finance this deficit? The largest one was through this, government security. They do a lot of borrowing in the fixed income market. That is the main part. A small saving also did, play a big part in overall government's, subsidy fiscal maths. Then otherwise, other parts are pretty much small. These two numbers are very, crucial for the bond market in particular. Generally, from a borrowing of around 4.5 trillion rupees, that has now gone up to around 11 trillion rupees. So this number is on the higher side. But okay, market was factoring in a little bit higher number, so they were quite comfortable with these numbers. Just this pictorial, have a look. The impact of which COVID has had on government's fiscal maths. From around 5-6 trillion rupees of borrowing, this borrowing has almost more than doubled. So that is one thing we should keep in our mind, that while government is embarking on a fiscal consolidation, the amount of borrowing and the amount of fiscal deficit is still remains quite high. But government is embarking on a fiscal consolidation roadmap, and it will gradually reduce, keep on reducing the deficit going ahead. Okay, so how were the numbers in the budget? Were they credible or not? We believe that the numbers were very credible. So, okay, when you are making the budget, what you look into is, number one, what is the nominal GDP estimate which you have taken? Government took a very credible number, 10.5%. Last 2 years numbers have been very strong. So their estimates on the nominal GDP at 10.5 was, I would say, very much believable and quite credible. In terms of tax to GDP ratio, again, it was quite a credible number, 11.1%. So, which means that the revenue estimate which they had taken are likely to be met, unless we have some big crisis or something like that. These numbers look pretty okay. In taxation front, income tax has been one segment of the economy which has showing very significant growth. I think this is the highest number ever in terms of income tax to GDP collection. And this, despite some changes in taxation and some giveaways which government had given in the new tax regime. Despite that, the income tax is supposed to likely to grow very fast. At 3% of GDP, it is the highest ever level of income tax from the government. And the reason why, one reason why we are seeing the stellar growth in income tax collection has been, the increase in compliance. So government has been doing a lot of work to increase compliance. And this is bearing fruit in terms of higher income tax collection. GST is another I would say a very good result of this all compliance and prevention of evasion measure which government has been taking, and this has also been growing at pretty strong number at 3.2% of GDP. So overall we have, I just showed you 11.1% tax to GDP ratio. How did it come? 3% income tax, around 3% GST, and around 3% corporate tax. The last part is around excise duty, which basically is mostly things like petroleum excise duty, which has been coming down. And I would say these three are more these three are taxes which are quite good for the economy in terms of their effect on broader economy. Corporate tax, you can see we had this sharp fall in corporate tax collection because government announced this corporate tax cut in 2019, but that has now again rebounded and gone back to 3.1% of GDP. So that's a broad maths if you have to see how government's taxation works. Besides tax, government also collects revenue from other sources. One is income and dividend which they get from PSUs and from RBI. There the number has been pretty okay, and we also get a lot of money from divestment. So that number they have again budgeted at around 50,000 crore rupees, which is similar as the last year's number. We may have some doubt whether this number will be achieved, but again, in broader scheme of things, I think the overall fiscal numbers looks quite credible. Now that was the receipts part. Now let's come to the expenditure part. Here, so we have broken it down to three parts, which is one is the capex. Just have a look here. It's all as a percentage of GDP, and capex at 3.3% is the highest level since FY04. So in the last 19 years, this is the highest capex which government is doing as a percent of GDP. Pretty sharp rise. So overall expenditure, government expenditure has been coming down, but the capex part has been going up. So while government is consolidating also, and it is also trying to improve the quality of expenditure. So in that way, it's quite good because capex is one which is likely to boost longer term growth and non-inflationary growth, possibly a growth which doesn't cause too much inflation, and also which is good for the external account also. So the quality of expenditure remains quite good. Just you can see here the same thing. The capital expenditure growing by 37%, RevEx going only by 1.2%. So pretty much very stark distinction that we have had. There was a lot of concern in the markets, in some segment of the markets, especially in the fixed income market also, that elections coming next year, government may look to pump prime the economy by doing more some populist measure, some consumption boosting measures, but they have stuck to fiscal consolidation, and most of the spending is happening in the capex part, not in the RevEx part, which typically includes a lot of populist measure inside it. So that's one good thing. In terms of key items, you look, just look at here, a big boost happening in the infrastructure part. So big spending happening in infrastructure. Otherwise, rural has declined from last year. Other welfare measures and urban have also been pretty okay. So the big qualitative shift from, I would say, rural and other welfare measures towards infrastructure. And within infrastructure, if you look, now, the key focus has been roads and highways, which has got a big share of government money. Also, railways is getting a big share of money. Otherwise, defense and other measures have been pretty okay. States are also getting a lot of money, specifically for the capex. So, I mean, in whichever way you look into the budget, everywhere you're getting the same message that government trying to pump to push economic growth on a medium-term basis by pushing for higher capex. And the segment which are getting the more money is railways, roads, and I would say states are getting a lot of money, and this money states have to use specifically for doing capex. So that's the good part. Otherwise, rural spending has contracted, which which would be a concern to some people. But this is it. The number has come down. I'll come a little later to this. Just have a look here. So why is the rural spending come down? The biggest cut have been in Manrega from close to 1 trillion rupee of spending. That spending has now government has now budgeted the spending to around only 600 billion rupees, so around 6,000 crore rupees. So a sharp fall here. Manrega is basically a demand-driven scheme. So whenever some rural person goes to the panchayat to seek work from Manrega, he will get the work. And government probably believes that with the worst of crisis, worst of pandemic behind us, the rural demand for this work will come down, and therefore they have budgeted lower number in Manrega. Otherwise, in rural roads also it has been pretty flat. Rural housing has seen a jump, which is quite good. Otherwise, other numbers are pretty flat here. If we just have a broader look into which segments of which segment of the economy is getting more money, where government is putting a lot of money. One worrying segment is interest rate, because over the last 2-3 years, I have just shown you the previous graphs that government's borrowing has gone up significantly. Therefore, interest expenditure has gone up significantly from around 6 lakh crore rupees to now around 10.8 lakh crore rupees in the last 4 years. So that is one worrying thing for a government's fiscal affair. Otherwise, the good part is that subsidies have come down sharply, both as I just mentioned, agri and fertilizer. That's one good part. And otherwise, you can see segments like transport getting big share of money, state getting big share of money. Otherwise, things are quite good. The only worrying aspect has been the rising interest cost for the government, because a result of the higher borrowing of the last few years. In terms of major welfare schemes, I just mentioned about Narega, where it has come down. Otherwise, PM Kisan, this is one segment where people thought that because elections are coming, therefore government may increase this allocation to PM Kisan. Here they kept it pretty stable right now. There may be some expectation that next year in the vote of account they can increase it, but this year they have kept it pretty flat. Otherwise, Food Security Act, this number has come down significantly, because as I just mentioned, the food subsidy bill has fallen because with COVID behind us, the free food scheme, at least a part of the free food scheme has been discontinued. Other segments, PM Awas, rural drinking mission has been getting a lot of money, and otherwise, pretty much flat numbers, as you can see here. Now, just have a look at government debt levels, where India stands. So just have a look here. So this is the growth rate of an economy, and this is the general government debt level of the economy. It is generally believed that if you have higher debt level and if you are growing fast, then the worry is not that much, because higher growth can pay off this higher amount of debt. And this is the worrying segment, this red line, because these economies have higher level of debt, but not high growth. India is just above that, so it's not within this circle. It's an okay level of debt for India. It's good if it comes down, But no, at these level, assuming that we can grow at 10% YOY on a nominal basis, this debt level at least looks sustainable for India. And just a cross-country comparison of India, where it stands since 2005, if you look here, most world economies had seen a big jump in their government debt levels, but India, it has been pretty much stable. So that's one thing. So while there is justifiably a lot of concern that India's debt level is quite high, government debt level is high. If you look, if you compare with other economies and especially developed economies, one, the debt level doesn't look that high, and two, it hasn't been increasing too much. And the reason for that has been that whenever you look into the debt sustainability, there are two things to look into. One is what is the growth rate of your economy, and second is what is the interest cost of the economy. So if the growth rate is higher than the interest cost, then every economies are able to pay back their higher debt levels. And for India, for most of the time, the growth rate has been much higher than the interest rate, and therefore we are broadly sustainable from the debt point of view. And then this just a final headline fiscal table for you people just have a look how government's budget is stacked in terms of the pure fiscal maths. So that's it from my side. So broadly, if I just have to summarize the headline message, it's a credible budget. It's a budget focused on capex, and which is good for longer term growth. And it's a budget which trying to push growth to the extent possible while sticking to the fiscal consolidation roadmap. On the flip side, I would say rural segment has got little less money, which maybe which can be some source of concern if rural growth doesn't pick up. But there's a limit to how much government can do given the broader fiscal maths of receipts minus expenditure equal to fiscal deficit. So I'll stop here. If you have any queries, we can take. Otherwise, Mahesh sir can take it forward.
I think
Bhupesh, so I'll take it up from here. Thanks, Bhupesh, for the overall macro explaining the budget in terms of revenue, expenditure, okay, and what has been the focus. But just to summarize, I would say that the budget is actually really directed towards the debt market, trying to ensure that the overall borrowing program of the government is in line with expectation. Okay, it is exactly in what we were expecting, trying to drive fiscal consolidation over a period of time, and keeping it very simple. Okay, we haven't seen any major changes in the budget, okay, which has got any impact on specific companies or sectors, except probably for the insurance sector, which we'll talk about it. But by and large, if you look at the focus, there's always a debate whether this budget is consumer, drives consumption or it drives investments. So our expectation initially was that this budget, since it is the last budget, proper budget before the elections, it will try to stimulate consumption, especially at a time when the rural economy has been weak after the second wave of COVID, and consumption, especially rural, is just about picking up. So, but I think contrary to that, if you look at the real focus of the budget has been towards increasing the capital expenditure, which is going up, as Bhupesh mentioned. It's going up by almost 33% or so. Again, whereas on the consumption side, except for the fact that there has been some transfer by way of rationalizing the tax slabs and increasing the threshold level for people who taxable income is free to around 8 lakhs, which is the only kind of a saving, okay, which the consumers will have, which is around 30,000 crores, which they can spend. But on the rural side, there hasn't been any major push. Our feeling is that probably they will do that more noise during next year, just before the elections, because that time the impact and the narrative, I think, could be much more stronger. Overall, I think the budget had enough room because the subsidy levels had come down dramatically, so that whatever savings and subsidy was there has been used towards increasing the capital expenditure. So as a result of that, I think clearly companies, especially in the areas like railways, where the rolling stock investment is seen a big improvement. Rolling stock means the locomotives and the wagons, and companies present in that sector, okay, should definitely benefit. Again, road sector has seen a big increase in the overall capital outlay. So that should also be supportive for the road construction companies. So that I think is the key positive for some of the companies in the infrastructure, capital goods, I would say, in the construction companies. The other larger impact of this budget was the biggest impact we saw from a stock market perspective or sector perspective was on the insurance sector, where there are two things. One is the now, I mean, in line with the government's philosophy of trying to get all savings, okay, under the tax route. So insurance, some of these non-par products, okay, which were there, they were still getting the tax exemption. And a lot of HNIs were using this product where they were getting guaranteed returns almost of around 6.5%, 7%, which on a post-tax basis were looking very attractive. And that was driving a lot of the growth of some of the insurance companies, not only growth also, but the profit margins. So that has been capped now. So any premium of more than 5 lakhs rupees on an annual basis will be taxed at the marginal rate. So that would have a clear negative impact on a lot of the insurance companies which were already struggling coming out of COVID. They were struggling on growth, especially on the term plans. And the growth driver was these non-par kind of products, savings products, which were there. And that clearly gets impacted. Also, with the government trying to move towards the new tax regime, so all the concessions under TCC, which was being used, that would also probably not be there if you move on to the new tax regime. And that's what the government trying to incentivize taxpayers to move on to. So I think that clearly we saw a large correction in the insurance stocks, almost 9 to 10%, 8 to 10% correction in the large insurance companies, which was a kind of a big shock. And we also, in our portfolios, we were positive on the insurance sector because you were seeing that the sector is now emerging back in terms of growth trajectory and can look like a good compounder from here with little risk. But this is a event which has really hurt the sector. And in some of our funds also, we have got decent exposure. We've got impacted because of this move. Apart from that, I think the budget on the finance, on the banking and financial, not material change, except for the fact that the whole the MSME credit guarantee scheme, which is there, so that has been further extended, okay, with the a new corpus of around 90,000 crores, which will enable government banks, okay, to lend unsecured loans to the MSE sector, guaranteed loans to the extent of around 2 lakh crores, which will be supportive to the MSCD segment. Again, they would also get these at a reduced cost of less than 1%. I mean, 1% lower than the market rate. So that's on the banking and financial services impact. Apart from that, if you look at some of the other sectors like real estate, again, marginally negative, not too negative. There are two measures, okay, which are there, which are impacting the real estate sector. One is on the REITs, where the debt repayment and the capital return of listed REITs sorry for disturbance. So on the real estate side, there are two changes, okay, impacting. One is the capital receipts of real estate of listed REITs that were initially currently tax-free. Okay, that will be taxed at the marginal rate. So so that could slightly hurt the investors who are looking at investing into REITs. And for large ticket size houses, the capital, normally when you sell a house, okay, if you reinvest that capital gains into a new property, okay, that is tax-free. But any capital gains above 10 crore, that will they will not get the benefit of tax exemption. So this is, that will only impact some of the large real estate companies, okay, which are there into premium property, especially Bombay developers, where there could be a slight negative impact, which is there. So apart from that, there's nothing really much in the budget which has a direct impact, large impact on any particular sector. As a result, we saw that the only, from market perspective, I think the budget initially looked good because there were no negative surprises, right? Market was expecting that there could be a capital gains tax, could go up, or the duration for long-term capital gains tax could be increased, but nothing of that sort happened. And to that extent, I think it is more about status quo, getting back the whole growth trajectory. And since the focus of the budget is on investment, so the medium to long-term outlook in terms of driving growth, I think that continues to be on course. So I would say that the market reaction after the budget, I think, was more to also do what happened to the Adani group of companies, the big IPO, which was called off, and the larger ramifications of that into the market, where we saw a large correction in some of these Adani group companies, which kind of spooked the market. Though, I mean, the banking system, which has got overall lending to the Adani group, is not that large, we think. It's just about 0.5% of the total assets of the banking system. But clearly, it has been a sentiment negative. And we've seen some of the banks' stocks and the wider correction in the market because of that. So that is what has led to the reaction in the market, I think, post-budget. Otherwise, the budget per se, I would say, is more or less neutral, trying to really drive the long-term growth trajectory, which what we have been saying, that while near term there are some challenges on the global front, there is a growth slowdown which is there, but I think India's long-term growth story is fairly intact. There are enough drivers for that, which is not only coming in from the demographic side, but also on the investment side, on the manufacturing side, the push, which the government started the last 2 years back, that has been further extended in this budget over there to try to really focus on the logistics side. So where the idea is to really bring down the logistics costs, and there are various measures which have been taken in this budget to drive in that direction. So I think while we are, but the government is expecting a GDP growth of around 6.4% next year, we've been slightly more conservative there, looking at the global backdrop. But I think over longer term, I think India should be able to really go towards its potential growth rate of around 6.5%. And that is good from a market perspective to drive pretty decent earnings growth. We are seeing that this year also, despite the global concerns and slowdown in a few sectors, especially in the consumer discretionary space, like consumer durables, if you look at, there has been meaningful slowdown in the last couple of months. But the earnings growth, even this fiscal year, FY23, is expected to be around 13 to 14%. And next year also, we are looking at around 14% kind of a growth. So that is the picture. There is not really changing much. The banking stock sector has seen some impact recently, but we don't see any larger repercussions of that because, if you look at the debt repayment of the Adani group companies, I think they are really long tenure and long dated. So that should not really impact the overall credit profile, of the banks. And as such, I would say that a lot of other sectors are also showing reasonably good growth. We've seen the auto sector coming back, and volume growth is slowly coming back, both in the four-wheelers and the commercial vehicles. Also, the margins this year, next year, I think we are seeing margin improvement across various sectors, be it the auto sector, consumer staples. In fact, in this quarter, we've seen companies actually surprising on the margins, especially on the consumer staples, like, for example, Britannia, which came with the results, or Godrej Consumer. And I think that will really drive the earnings growth. It's not only top line growth, but the margin improvement. Even the sector like IT sector, which is likely to see some slowdown next year in terms of the top line growth, while the top line growth will slow down from around 13-14% to around 8 to 10% kind of a growth. The profit growth will be in double digits because the whole pressure on wage inflation, which was there, that is eased off significantly, and the rupee depreciation should help. So we are not seeing any large impact on corporate earnings, and that will continue to drive the market from a medium to long-term perspective. And our view remains the same. I think post the budget, I think what we had at the beginning of the year when we came with the annual outlook, and we said that this year is going to be the year of consolidation. We'll see some valuation multiples, which are slightly expensive. Indian market was expensive compared to its long-term average. There will be some normalization of that because of higher interest rates and tighter liquidity. So to that extent, the return will be more moderate, say in the high single digits. But the long-term structural growth of India continues to will do well, and the long-term returns will still be in the low teens. So that's outlook, I think, remains as it is. In the near term, though, we've seen FIs have been selling relentlessly. In the last month, in the January month, there was a large amount of selling. Again, that is more to do with the fact that other emerging markets, especially Korea, Taiwan, and China, which had underperformed significantly last year, were looking fairly attractive. And the opening of the Chinese economy will mean that they will see some kind of a strong growth, at least for a few quarters. And investors wanted to play that trade, and we saw relatively money moved into these markets, and that's the reason why we've seen the FI outflows, and that has led to India's underperformance in the last 1 month. Now, post that, the large premium which India had, valuation premium vis-a-vis the emerging markets, that has now got corrected because India has underperformed, and these markets are, some of the markets are up almost 30% in the last 2 to 3 months. So that is slowly getting normalized. And a lot of investors only see, when we talk to large foreign investors, they see only it as a trade of getting into China. They don't really see the whole China growth story will sustain, because the demographics in China are also now not as favorable. And the whole banking system and the real estate sector is still going through that pain, which will take time for them to recover. So I think long-term investors are still looking at India to really play the long-term growth story. And we would see the foreign flows. I think once the China trade plays out in the next couple of months, I think you will see money coming back into the Indian markets. And with the correction and some time correction, I think the valuations would also look fairly reasonable now. So, and even on the global front also, I think the whole narrative about inflation, I think, is now no longer a concern. We are clearly seeing signs of inflation now moderating down in the US also. Both the housing prices as well as service prices, service inflation has come down. Labor market is still fairly tight, but I think the increase in rates, okay, is not going to be as much, though rates might remain higher for longer is what we think. So in that scenario also, we don't see any major kind of a downturn in the global markets. They will probably go in some kind of time correction, and that means that India also we're not seeing any large correction. I think the recent dip in the market is a good opportunity to really add, because that doesn't change the overall medium to long-term picture. So that's it. I think halt here, and we can now have the Q&A session opened up.
Thank you, Mahesh and Bhupesh, for a very insightful and detailed presentation. While I request all the participants to maybe raise hands or post the question in Q&A, we have a set of 3 questions which we've received. Karthik essentially asked that should we avoid companies in two-wheeler segment as rural spend is not that great? while there is solace that EV and lithium ion battery would, I think, take off is what he meant. So Mahesh, any thought on this?
So again, the budget doesn't really have much anything to talk about, okay, on the auto sector or for that matter, to stimulate rural growth. So the two-wheelers has still been lagging. If you look at the two-wheeler sales today, they're still significantly lower than the pre-COVID levels, right? What sales we are doing. Whereas in the passenger vehicles, now it's really caught on with that. Even a commercial vehicle is also catching up. So the demand has been weak, and more, I mean, the transition to EV has also been a challenge because you don't know who will be the winner and how the market shares will shift because of that. So that's the confusion, and that's why some of the two-wheeler stocks are kind of trading at multiples which are pretty low compared to their long-term average. And companies which got a clear strategy for EV transition, they are probably doing better within the two-wheeler space.
Sure, Mahesh. There are two questions pertaining to the insurance industry. One is in terms of the long-term impact, and second is what is the tax rate of insurance for more than 5 lakh rupees? What if people bought a policy on 31st March 2023 and pay more than 5 lakh premium? Is it taxable? Is the question. So I think.
Sure. So on the insurance sector, I think this has clearly been a big negative because it impacts your growth also, because a lot of growth has been driven by, I mean, that, as you know, in the insurance, there are two parts, right? One is the term plans, okay, which are there. And then there are these saving products, which is ULIP. And then there are participant and non-participatory products, which are there. So term plans were sluggish because the term premiums had gone up. The reinsurance post-COVID, they started charging a higher price. And we've seen slow growth over there. Now it's slowly coming back. And the driver for growth was these other savings product like the non-par products which are there, which was being sold very aggressively. And since they enjoyed tax benefit, a lot of people who were looking at the post-tax basis returns there were fairly attractive. And the margins also in these products were much better. Now with this cap, you could see some, because though not everything is, I mean, different insurance companies have given different percentage. Like for example, HDFC Life has around 10 to 11% of their overall premiums, okay, which fall under this category. Right? In some of the, like SBI Life, it is much lower, what they have clarified. So depending on that, I think the impact would be there. But clearly, I think in the next 1 year, you might see, because of this lower top line growth and lower margin, the profit growth will be very muted. So, but I think over longer term, it doesn't really matter because they will move on to some other products. So it's not like this is the only product, okay, which is gaining traction, and market will get adjusted also. And you are, in terms of the question about anything above 5 lakhs, so 5 lakhs is not, it's an aggregate, right, of all the premiums, okay, which one is paying towards insurance, right? So it's not for one, if you have got insurance from multiple companies and different plans. So aggregate of that, okay, if it is more than 5 lakhs, then that, I mean, I mean the savings, okay, I mean the income from that, right? Whenever these plans mature, the savings plans, okay, that will be taxable at the marginal rate.
Fair enough. I'll just try to unmute Vibhor. He's raised his hand. Vibhor, can you please ask your question? Unmute yourself and ask the question.
Let's take the next question, Joseph.
Yeah, I was not sure that I'm not able to hear. Mahesh, there is a question on which fund should we suggest for SIPs to client having current age of 24 and time horizon of 8 years plus.
So I think funds typically for young people would be long-term growth-oriented funds, right? And because that's where the compounding would happen. So I think in that category, I think the flexi cap fund or a multi-cap fund or even a large cap fund, I think all these funds I think would be ideal for SIP. So say in a stable fund like frontline equity fund, for example, or our BSL flexi cap fund or our BSL multi-cap fund, I think these funds would be ideal for especially the youth, okay, who's really looking for long-term wealth creation.
Thanks, thanks, Mesh. So there is a question from Karthik, and I think Bhupesh, it's for you. That generally.
Joseph, we can't hear you.
Am I audible?
Yeah, yes, indeed, you're audible.
So the question is, insurance companies are the ones who generally allocate to longer dated securities. Owing to the recent change, how will the long-term yields be impacted?
Yeah, fair question. So insurance companies typically, because of the asset liability profile, they typically invest in longer duration paper, 15 years, 20 years, 40 years. And if you see, over the last 1 year, because these schemes were getting a lot of money and insurance was getting a lot of money, the spread that you typically get between a 10-year paper and these long dated papers had come down significantly. On an average, this spread over the last 10 years, if you look into, the spread used to be around 25 to 40 basis points. And those spreads had come down to around 10 basis points. Now, with this, if this tax change does have an impact on these particular products and into insurance inflows, it will, result in our sense to normalization of the spread from this around 10 basis point to closer to back to the normal levels of 35 to 40 basis points. So that is quite possible that the spread which has come down significantly, that should again begin to normalize. But this thing is going to happen from next fiscal. So over the next 2-3 months, next 2 months, I think insurance will keep on getting flows. And over the next 2 months, we don't see too much normalization of the spreads. But once these products start getting lower flows, we can have these normalization. That has been the one reason why some products which were targeted for very long end papers, they had outperformed other similar somewhat lower duration papers. Now that will begin to normalize.
Sure. Thanks, Bhupesh. Manish, there is a question for will consumption theme perform better compared to other themes in coming years? Is a question, and I would like you to respond to that.
So consumption theme has in India, I think is a long-term theme which will continue, right? So there are, except for the period during COVID and its impact, we saw consumption getting impacted. Initially, it was urban consumption and then it was rural consumption. And that is now slowly coming back. So I think that consumption story in India, which is not only driven by the demographics, but also with the per capita income going up, the new generation, which is kind of the millennials, the aspiration levels are higher. They are willing to borrow, right, leverage and also consume. That will drive consumption, especially for discretionary consumption. And that I think is a long-term secular growth story for India, right, which is capturing the young generation, young India, the demographic profile, and the rising per capita income. Is a combination of and also more urbanization, as it is driving all these factors will drive the consumption theme in India. Again, in the near term, also I think the rural consumption is also likely to pick up because while the budget hasn't really done much over there, but we've seen that the rural wages are starting to move up. The Rabi crop has been good, and that should, at the margin, at least compared to last year, see better delta. So I think that continues, but clearly the change would be more in the investment-led growth. In the last 8 years, if you look at it from 2013 onwards to 2021-22, investments have seen contraction as a percentage of GDP, and that is likely to revive. I mean, not only from the budget, okay, the states, I mean, the central allocation, states are also allocating more, and the private sector also, capex is slowly likely to improve. Still early days, but we expect improvement over there in the next 1 year because the capacity utilization levels are now reaching levels, okay, which will mean that incremental capex needs to be done for meeting the future growth. And overall bank balance sheets are also in fairly good shape, okay, to lend. So I think at the margin, I think the investment-led growth, okay, that could surprise us compared to what it has done in the past, and that can be a more, I would say, stronger trend which you could witness, and which will help companies, say in the in the capital goods structure or the infrastructure side. I think they should see a much stronger growth.
Sure. Manish. So there's this question around your views on IT and pharma sector, considering that the valuation advantage and cooling of US inflation that has happened recently. So yeah.
So the outlook on the pharma and the IT sector, you're saying, yeah? Yeah. So I think the IT sector clearly has, it underperformed last year because of the derating of multiples and the concerns. I think it's now stabilizing. We've seen that even this quarter, we would have expected some downgrades to earnings, which is not happens. Companies have actually maintained their guidance, and overall rupee depreciation is also helping at the margin, as I mentioned earlier. So while the overall global growth is likely to slow down, we see only a limited impact there on the Indian IT companies. And I think the sector, the companies are good. They have got good cash flows, which they're probably doing some buybacks also. So the sector doesn't look to be a high growth sector, but looks to be a steady sector here, which should provide stability to the portfolio. I mean, the market's correct. I think probably IT will outperform, and that's what we're seeing recently in the recent correction. Pharma sector outlook, there are some headwinds there from the US side. US generics market is slightly seeing some pricing pressure still. Domestic pharma is companies are much better placed in terms of driving growth. And so pharma will remain more stock-specific companies which are really getting into specialty pharma and moving up the value chain investing. They will probably still be able to compensate for the decline in the US market, generics market, because of pricing pressure. So it will remain very selective and stock-specific in the pharma sector. We're not seeing any big tailwind, okay, from the export side there.
Thank you, Mahesh. Bhupesh, there is a question in terms of is our view around it, and I think from what I read, essentially it's in line with our view, but I just would like to hear from you.
Joseph, you're not audible. I can't hear you.
The view around it, like to hear from you.
So the next question is, will simplified KYC regime in the new budget benefit and attract more investors to capital markets and investment products?
Yeah, so I mean, I guess so. I mean, anything which you do of ease of investing, right? It should help, no? In terms of investors really able to quickly onboard and be able to actually penetrate and drive deeper. So yeah, I think that should be positive.
Sorry, there was a little bit of unstable internet connection. Mahesh, I think for now, what I see, there are no further questions. Would you like to, Bhupesh and Mahesh, just summarize the call in terms of our final view, and then maybe we can conclude the call if there are no further questions.
Yeah, so just to summarize, I would say that overall, the budget, I think the budget event is now behind us. There were no negative surprises. It's pretty much on expected lines. Marginal impact, okay, especially on the insurance company. Otherwise, there's nothing really adverse which is there. The government continues to focus on long-term growth, I think, which is very important from long-term sustainability of India's economic growth, which will not only drive growth, but also drive the markets from a long-term perspective. So I think that narrative remains over there. And I think the focus will now come back from a market perspective, right, in terms of how the domestic story pans out. We've seen some volatility recently because of the recent challenges, okay, from the Adani Group, but I think that is also something I think which I don't see that as a big risk, okay, which will really pull down the system. And I think the correction what we're seeing in the market would be a good opportunity really to invest, because the markets which were looking expensive are now, at least in some pockets, is offering now a good value.
Thank you, Mahesh. So there is one question which is, Bhupesh, maybe you can take this as the impact of increased limits in senior citizen scheme, and what is your take on that? And post that, I think maybe you can have your concluding remarks as well.
Yeah, so the thing is that government borrowing has been consistently rising. Government fiscal deficit has remained high, and typically 30-40% of about 30% of the total funding of fiscal deficit used to happen from the small savings part. Now, as the amount of borrowing keeps on increasing in nominal terms, it's very difficult for small savings to catch up with this higher level of government demand, which is there to fulfill the fiscal deficit. And therefore, it was quite, and also recently banks have been raising their deposit rates. So there's a competition also which is there between banks and small savings in terms of attracting deposits. And if government had to fulfill its fiscal deficit requirement from the small saving part, given the onerous requirement, because the actual level of deficit has increased in nominal terms, they had to have some scheme to attract more funds to the small savings. And I think small savings, the senior citizen small savings scheme is, I think, quite a lucrative scheme. The interest rates are quite high for the senior citizens. And it is part of the government's effort to keep small saving attractive at a time when banks are also raising rates, and also at a time when government's funding requirements also remain quite high. Nevertheless, it will have some impact on the amount of deposits which go to the banks. So there will be some competition and some upward pressure on bank deposits. And ultimately, all this is public money which is going to the government. So it will also have impact on overall interest rates in the economy. I think for investors who are in small saving, I think it's a good scheme to put money on. So that's the crux. Otherwise, Mahesh has, I think, summarized budget from fixed income side. It's a good budget. They have ticked all the boxes in terms of it's credible numbers. Fiscal deficit has come down, but the consolidation is going on. And because it's a capex driven budget, therefore it will not be considered too much of inflationary. Therefore, RBI will also be happy with the budget, and that should have a positive impact on monetary policy going ahead. And also, because a lot of spending is being done on infrastructure and highways, it should lead to longer term growth of the economy. And because too much money is not being spent on consumption in the budget, so it should also be positive for the balance of payment and the current account. So net, at least from the fiscal side, I think it's a pretty decent budget. And that was the reason why we had seen a rebound in markets yesterday. Yeah, so I think it met most of our expectation and most of the expectation of the markets.
Thanks a lot, Bhupesh, for that succinct recapturing of the highlights of the budget. Thanks a lot, Mahesh, for giving us time. And at this hour, I would like to conclude this call. And thanks to all the participants for joining us. Thanks a lot.
Thank you. Bye.
Bye.
Thank you.